Pankaj Pandey, Head of Research with ICICIdirect joins us. Pankaj, good morning and thank you for joining us. Pankaj, today we may start with a rub of red on the screen, but of late Indian markets surely have managed to chart their own course. What do you make of the recent price action? And if markets fall today, would you be a buyer there?
I think if you look at Nikunj, from Feb lows, we have gained about 10% and largely driven by the improvement in sentiments because economic numbers have hardly seen much of an improvement. So from that perspective, if you look at sentiments, probably can take the markets to even further higher levels over the till ahead of elections to about 6,000, between 6,500 to 7,000 kind of a range. But having said that, we wouldn't expect markets to sort of rally too much beyond that because again the growth is driven by few select sectors, and of which IT and pharma probably I think the performance might get tempered from here on because of the issues what two companies have disclosed. So from that perspective, I think one should be buyer in the market still ahead of elections, but post elections I think one should be sort of, I think before that one should book profits and be out of the markets because the growth is still not there to actually support this rally going forward.
Pankaj, hi, morning. Clearly, IT was the biggest loser in trade yesterday, with Infi being the big disappointment, especially after Narayana Murthy's comments and as to how they see growth only lowering. How would you approach IT as a pack and Infosys in particular?
So IT, if you look at going forward, I think Rupee appreciation would be a sort of a concern for them because till I think if you look at last year, they have been performing quite well with dollar revenue growth of about 3 to 4%. Now, going forward without Rupee depreciation, it will be very difficult for them to sort of justify the rich multiples which these stocks have been commanding. I think besides Cognizant, Infosys yesterday also has sort of sounded cautious on the growth outlook front. So even if they do lower or if their exit velocity is lower, I think even for achieving NASSCOM guidance, they'll have a lot of problems to face. So accordingly, we have cut our growth estimates. So we have cut EPS estimates for both FY14 and 15, and accordingly our target price has come down to about 3650. Defensives, we would be on both the segments, which both IT and pharma because of rich multiples. And within defensives, we have been preferring FMCG because of a better set of numbers, and also from the fact that the valuation differential between the other two defensives and the FMCG is not so much. So for example, if you look at Sun Pharma was trading more or less similar multiples like ITC on FY16 basis, whereas ITC would have a better free cash flow generation. So from that perspective, we would prefer FMCG.
Okay, let's look at the other one. And Sun Pharma also saw traces of profit booking, even though most of the brokerages are still maintaining that one should not read into the US FDA alert, as the core business for Sun Pharma is still intact. The concern for Sun Pharma clearly is that valuations are looking slightly lofty, and even after yesterday's decline, Pankaj, Sun Pharma is still trading at a P multiple of about 30 plus based on FY15 estimates. Do you think in the short term, is the springtime for Sun Pharma over?
I think, like I said, for both IT and pharma, I think the pace of appreciation would get tampered. So, for example, from a growth perspective, we would expect Sun Pharma to deliver about 21% kind of a top line growth. And this stock is already trading post correction at about 20 times FY16 basis. So, still quite decent or rich valuations, if I can say. So, from that perspective, I think both these segments would sort of continue to sort of consolidate over the next probably 1 year, like the way which has happened in the FMCG sector. So FMCG sector, we have seen the biggest P multiple re-rating which has happened over the past 4-5 years. So from about 20 times forward, they have gone to 30 times forward. And we have seen the time correction happening in FMCG sector. I would expect both IT and pharma also to witness a similar kind of a time correction. And I think that should be quite healthy, and which is what I think we would expect, and accordingly, since FMCG has sort of done more of a time correction, valuations have sort of are more compelling compared to earlier. So which is why we would prefer some of the names like ITC with a target price of 387. We also like Marico with a target price of 260.
Coming on HPCL and BPCL, Pankaj, do you think there is still some more steam left for HPCL and BPCL? Because for other sectors, there is still hope that news flow and reforms would kick in. But oil marketing space is one space where reforms have already kicked in. And the way diesel prices have gone up, surely these companies are poised to report higher profits.
I think from a shorter term perspective, if you look at definitely these stocks can head higher because of the momentum which is there. But having said that, if you look at from an overall perspective, we don't expect much of a volume growth to happen for most of these companies, including the upstreams. So the play is again on the crude oil front and how the government would sort of react to the crude oil price movements. And I think these stocks have been historically been cheap for a good period of time. So technically you can play them out, but fundamentally I wouldn't be really chasing both upstream and downstream counters. But within the oil and gas space, if something has to be looked up, I think the upstream space makes better sense. Otherwise, I think it is better to stay away from this counter, and I don't think that within capital intensive sectors, I think beyond IT and cement, other sectors would make sense from post-election perspective. So I think because the economic growth is still sort of fragile, and one should not be really sort of banking that we would see a more of a progressive recovery. Or so with all these concerns, I think two sectors, auto and cement, should benefit because they have a better balance sheet.
Pankaj, do you think there is merit to revisit Mahindra and Mahindra? Because not only they've stopped losing market share in the SUV market, what has done the trick for Mahindra and Mahindra is the uptick in the tractor sales. And for the quarter gone by, Mahindra and Mahindra has reported a big uptick in the tractor sales.
Correct. Nikun, if you look at tractor sales have been doing quite well for them, and is expected to continue to do well. But how the concern would be on the UV side, so which is where we would expect more launches to happen next year, and you would have higher competition. So that is one segment which would be a sort of worry. But having said that, I think the entire auto space, if you look at, there's hardly been any growth. So combined two-wheelers, the growth is about 3% odd. What we would expect is that in case if the overall economy recovers, this sector could witness a growth in the range of 8 to 9 odd%, and which will benefit most of the players, and which is why as a sector we are positive on most of the counters, including Mahindra and Mahindra. So Tata Motors, Mahindra and Mahindra, Bajaj Auto, even companies like Bosch also we are positive on. So I think this is one sector which one can really look at sort of buying even at current levels, because the valuations are not that expensive. These stocks are available at 14 times forward basis. And with the kind of growth and with the kind of operating leverage, we would expect this sector to do well. And I think this sector has got a better balance sheet, so which is why even if somebody is sort of holding it post-election outcome also, one can really look at. So I think these are the stocks, or this is one particular sector which one should be particularly sort of chasing, given the kind of concerns which are there on some of the defensive names.
Pankaj Pandey, final question to you. Give me 3 stocks where you're advising your clients that they should buy them today, and you are reasonably confident of a 10% appreciation before the elections.
I think 3 stocks which one can look at. One of them would be ITC, the other one would be Titan because of the currency appreciation what we have seen, and the third stock would be Ultratech Cement. We believe that this particular stock can also deliver more than 10% kind of return.
Ultratech, Titan and ITC. Pankaj, the common linkage here is that all of them are very expensive stocks.
Correct. So if you look at, we like all the 3 stocks for different reason. Again, FMCG gets preference because of the relative underperformance which we would expect from IT and pharma space, plus relatively better multiples. I think Ultratech, if you look at, is trading somewhere about more than $120 EV per ton on a forward basis. But having said that, if you look at the, I think the balance sheet, we don't see any concerns. And as and when the demand gets revived, we would expect this stock to do, or in fact the sector to do quite well. In fact, last quarter was quite bad. So from that perspective, lower base, we would expect this sector to do well. I think Titan we like from the fact that we would expect the government to sort of ease off certain controls which they had imposed. So because of which we believe that the jewelry segment would continue to drive the growth going forward. Trading at about 20 times. So I think we believe that even though it might appear expensive, but it has always been expensive. So we believe that these three stocks can deliver more than 10.
Right, Pankaj. Okay, good to have you on the show, Pankaj. We're going to let you go on that note.